Welcome to Independently Wealthy 3 Minutes Investing. I'm Dianmu. Recently, we're experiencing some market turbulence. This week, we're going to look at two different models for relations between price and value. To be clear, price is the dollar amount you pay. Value is what you get after purchasing, and they're not the same thing. In academia, efficient market theory is taught in all economic programs and business schools. Efficient market theory describes that the market knows all information about publicly traded companies, and it accounts for all this information in their stock prices. According to this theory, stocks are always traded at a fair value. Therefore, it is impossible to have an edge and beat the market. But is it really the case? Is the market really this efficient? Let's do a thought experiment. Think of a big, well-known company, say Apple. The highest price for one share of Apple in the last year is 183, and the lowest price in the last year is 122. This is a pretty wide range. If we calculate its variation percentage based on its lowest price, it's almost 50%. If the price reflects the intrinsic value of Apple, it means the company's value changed 50%. How could this be? Apple is a pretty big company. For the company's value to change 50%, it means the company suddenly grows twice its size or shrinks down by a half. But the company certainly didn't have such a drastic change in the last year, which means its price fluctuation has little to do with the value this company provides. To avoid the cherry-picking effect, let's take a look at other similarly well-established companies. The highest price for one share of NVIDIA in the past year is 346, and the lowest is 135. For Nike, the highest is 179, and the lowest is 107. For share of Amazon, the highest price is 3,773, lowest 2,088. These are well-known companies operating in very different industries. Their prices have pretty wide range over last year. Could it really be possible that something major happened to all of them within the same year that led to these price changes? What are the odds? The clear-headed listeners must have some serious doubt about this efficient market theory by now. Let me introduce Mr. Market, the more realistic model invented by Benjamin Graham, the founder of value investing. Mr. Market suffers wild mood swings constantly. Every day, Mr. Market offers a price to buy and sell stocks. Sometimes, Mr. Market is extremely upbeat. He'll pay a very high price for a just okay company. Other times, Mr. Market thinks the world is ending and he wants to sell out everything fast, even if it means he only gets paid a fraction of its value. This irrational side of Mr. Market captures stock price changes more accurately. This is also the theory value investors such as Warren Buffett relies on to keep getting way above market returns.